And I'd like to paint a global picture here, and some of my remarks, purely by chance, I think might resonate with what Robert has just said. As the Secretary General of IOSCO, IOSCO is the International Organization of Securities Commissions. We have all the world's securities regulators as part of our organization. We have a big job here in this process of financial repair at the global level, so we're, if you like, responsible for the securities arm of the G20 and the Financial Stability Board and all of that. And I'd like to begin, if I may, this morning with two pieces of good news, not just one. The first, I think, set of good news is that when I was at the plenary session of the Financial Stability Board at the beginning of last week, I think the mood has definitely changed among the world's global regulators, and here you have the central banks and the insurance and the securities regulators of the world. For example, in the room is Paul Tucker, Lord Adair Turner for the UK. The Americans, always difficult to know how many US organizations there are. There are actually 6 or 8 of them. But everybody basically saying that the world is looking at a better place. The risks have changed from those dark days of last summer on whether the euro would survive to different types of risk of a low interest rate environment, compressed corporate bond spreads, booming corporate bond markets in emerging markets. So a different and perhaps much more positive mood. That's the first piece of good news I have for you. And the second is that, and this is, I think, my own good news, is that it seems to me that the future of market-based financing in the world is set to increase dramatically. I think most people get it and understand it, and every time I put forward that thesis, I've not been sort of bashed down. And I do believe this for a number of reasons, and let me tell you this morning why there's going to be tremendous opportunities going forward for trading, for equity markets, for all exchanges, bonds, commodities, derivatives, you name it. Why? Well, first of all, let's be logical. The Basel Agreement ratchets up capital for the banking system by 5 times or more. And even though we've seen at the end of last week some rather variable risk weights attached to some of the calculation of those capital levels, the capital levels in the banking system are going to go up and are going up dramatically. And I don't see any evidence at all, on the contrary, any evidence at all that those capital levels will come down in the future. If anything, I suspect they might go up more. We've got liquidity coverage ratios, leverage limits, etc., etc. So that means that the provision of credit in the economy is going to be, again, talking relatively constrained. And then there's another fact, which is if you look at the international discussions on margin requirements for OTC derivatives, or margin for clearinghouses, or haircuts for repos, then you're going to see more capital tied up for collateral provision. Some people worry about a so-called collateral crunch. But all of this is going to, it seems to me, constrain credit provision and require market-based financing to fill this increasing financing gap at the global and local level. Now, of course, it could be filled by the public sector. Well, that's not going to happen. I think all countries around the world realize that they can't open the taps out on the public sector deficits, and we've seen what happens when they do in Europe and elsewhere, US as well. That isn't any sort of formula. There's a logic here that tells me that market-based financing is going to have to fill and play a much, much bigger role in the financing of the global economy in the years ahead. And then, of course, we've got the growth in the emerging market countries. Now, this growth, as you're all perfectly well aware, is very large. Sometimes, we forget that, for example, by 2020, China, Brazil, Russia, Mexico, India, and Turkey will have overtaken the G7 in terms of GDP. China overtakes the US by around 2040. In the top 50 or so countries in the world, according to HSBC, many of those, 11 from Latin America, 17 from other emerging countries, are going to be in that list. So we are going to see dramatic increases in the performance and economic development of these countries. And I personally have seen that. I'm sure you all have as well as you travel around the world. And there's a sense of optimism, I think. There's a sense in Asia-Pacific region that they've got some things right in this crisis, and they have a good model for growth. So we've got three factors here. We've got capital levels being ratcheted up in the banking system, collateral provision increasing dramatically, the public sector unable to provide the financing void, market-based financing, and huge growth in the emerging market country. I think another factor here is that when I talk to all my members, and 80% of the securities regulators that are my members come from the emerging market countries, they realize that they simply cannot rely on the international banking system to provide the capital they need for their economic development. They have to, this is what they say, develop their local capital markets. And I see that discourse, I see this all over the world, in Africa, in Asia, in Latin America. In other words, the securities regulators have got it. And the real challenge for us, I think all of us, is to help the development of those securities markets, and we're going to try and do that in IOSCO by building a foundation to provide the technical assistance to do this. Now, I think these forces that I've described are irreversible. I think they're accelerating. I think we could be surprised at the speed of this change. I think technology, interconnectivity, internationalization of investment flows means that we could be underestimating the speed of change. Now, of course, there's one assumption here that we don't have massive political turmoil or catastrophic wars. I think that's a fair assumption to make. So if I'm right about this, there are a new set of challenges that are going to face us. Much more complex interconnectivity of markets. Unless we adopt best-of-breed standards for those markets, we could end up with severe regulatory fragmentation, which could be a lot worse in a much more complex world of big capital markets, many more than today. Could it be that we're going to have much more volatility, more complex market abuse cases to deal with? That's why the supervisory cooperation that we encourage in IOSCO through our exchanges of information for market abuse cases, or the development of the legal entity identifier, the global level becomes very important. Could we be facing concentration risks in this new world? Could we be facing a desert for SME financing? And that's important because that's where a lot of the growth of the economy will come from. So perhaps, like never before, the exchange world, the trading world, faces here a really rather positive scenario. I hope I'm not making that up. Do tell me if you fundamentally disagree, but I've tested this a lot. Now, what are the conditions? What are the necessary conditions for this to work out in a good way for everybody? And I think the first thing that we have to say is that nothing like this is going to happen unless we adopt, and not just adopt, but implement at the global level some key policies which will make the global financial system more stable. And I call them the big five. We can all have our lists, but for me there are 5 big issues. The first of them is resolution. In other words, failing firms, banks, asset management companies, exchanges, whatever, have got to be wheeled out to the corporate graveyard without mercy, without public support, and without contagion. That is the biggest challenge the world's financial regulators have. We're on the way. Paul Tucker, Deputy Governor of the Bank of England, has done magnificent work in installing the bail-in philosophy. But there's a long way between that and actually making it work on the ground. And one of the things for it to work is that we've got to know who's in charge. We can't have multiple regulators in charge if a big firm fails. No ring fencing. We've got to deal with burden sharing, all that stuff. So this is crucial. Absolutely crucial. Second, OTC derivatives. Big opportunity here for the exchange world because all the world's regulators are trying to drive as much of the derivatives business into standardized form onto exchange. They clearly say that through the clearing system. Believe it's safer, netting off positions. So this is absolutely critical, as is the work that's currently going on, and you'll see a big statement on this probably at the beginning of next week, or at the latest at the end of, possibly at the end of this week, on margin requirements for OTC derivatives that are not on exchange. Incentive systems to drive this business onto exchange to make it safe. Good news for you. Then we've got the third, which is the shadow banking areas. This is piloted at the global level by Lord Adair Turner in a very impressive way. But I have to say that I think the world's regulators, in a way, are still struggling to fully understand it all. The interconnectivity between the money market funds, securitization, the repo markets, and so forth. And it's big, this shadow banking world. It's sort of 25% of the banking system or bigger. And we're just sort of working our way through it, beginning to get better at it. What firms should be brought into the net here? Non-bank, non-insurance. So this is a critical area as well. And also for the level playing field arguments that we'll come on to. Basel, I mentioned, that's the fourth of them, implementing the capital standards, but not just implementing them, but ensuring that they're implemented in a consistent way. And the fifth one is what I call behavior. I think nothing has rotted the financial system more than the sort of behavior that has been far too prevalent. And this means changes of ethics, boardroom culture, corporate governance. And I'm afraid, yes, it means much tougher sanctions regimes. Most of the sanctions regimes in the world are laughable. Some are getting better and tougher. But I think they are not enough, not dissuasive enough. They don't deter. We're actually beginning work in IOSCO to look at the elements of deterrent sanctions regimes. So those are the five. I repeat them: resolution, OTC derivatives, shadow banking, Basel, capital levels, and changing behavior. Those are the five key ones, which we must get organized and agreed and implemented for this rosier world of the transition from banking to a market-based financing system to work. The second set of conditions is what I call reducing market abuse in general. I think we would all agree there have been far too many scandals. And again, that is just going to deter investors from markets. I don't have to repeat them. The mis-selling scandals, the insider trading scandals, the LIBOR scandals, the pyramid structures, money laundering, tax evasion. It just rots the financial system, and it's got to stop or be significantly reduced. Thirdly, I think we have to be clear that our trading and exchange arrangements, our platforms, however we do this, and it should be varied across in different markets. There shouldn't be any prescription here. But all buyers and sellers, all customers, particularly retail customers, have got to be treated fairly and not discriminated against. And so it's all that agenda of fair access and order handling, best execution, disclosure. It's absolutely critical if we're going to build that market-based financing world I described. And then we've got those tricky issues, haven't we, which I think will always be argued about, the lit versus the dark, the transparency, liquidity trade-off. How much technology? What about high-frequency trading? Who benefits from high? Is it benefiting in the whole market? Well, let me tell you that some of my regulators, my board, who's on my board of the IOSCO, I have all the world's top securities regulators, pretty concerned about high-frequency trading, to the point that some of them think it's potentially systemic worries, and we're going to discuss this at our next IOSCO board meeting in March in Sydney, Australia. So all of this has got to be seen to be in the public good. Another condition for this nirvana or this promising world that I've described is that and this is throwing the ball at myself, is that there has to be much stronger coordination among the world's global regulators. And it's no good, frankly, believing that just like miracles happen, that they'll all sit down and agree. They won't. There are very different philosophies in the world. And the trick here, in my view, is to start to think about the types of global institutions that we're going to need to make this global reform agenda work. At the moment, we have, at the global level, no enforcement powers, no dispute settlement. So if two big blocs, so let's say the EU and the US, disagree about the rules for derivatives or registration of derivatives dealers, swap dealers, and so forth, there's no way of resolving it apart from the two parties finding some sort of agreement. And often here you have conflicts of laws. So, in the longer term, in that complex world I described, many more big capital markets, who is going to be the arbitrator? How do we resolve disputes? And I would like the industry, in particular, to start pushing towards, pushing us, the regulators, towards thinking more about the types of global institutions we need. Now, some people talk about mutual recognition will do the job, substituted compliance, the US terminology, and so forth. I don't believe that. I think it can help. It can be a first step. But the problem with mutual recognition, it's always discretionary. If Robert and I give each other a mutual recognition tick one day, we might the next day decide we don't agree. And therefore, we each have to regulate each other's business when we shouldn't have to. So it's discretionary. And in a matrix of many big markets, I just can't see how that can work, frankly. So I think it pushes us towards global institutions. Another condition for this new market-based financing world is that we have And the regulators have a big responsibility here. We've got to make sure there is a level playing field among all market participants, traders, exchanges, MTFs, investment banks, whatever. And this is difficult. I've had my own experience when we were piloting MiFID through of trying to find that balance. You can never be sure. But if you do see unevenness, you have to adjust it quickly in order to maintain fair competition in the markets. This is absolutely essential. The regulators should not privilege one part of the market over another, and I always try to avoid that. I'm not sure we always succeeded. We also got to do much more sophisticated economic analysis before regulating at the global level or indeed at national level. I don't think we fully understand enough about the interconnectedness between markets, the spillover effects, and so forth. We need to be much better at this. We're actually running the world's financial system. It's rather like trying to run a power station without knowing where the tubes go, or what the pipes are for, or what the dials are for. We actually have a very imperfect understanding of how capital markets, world's capital markets, actually work. Another factor which would help us enormously in developing this market-based financing nirvana would be having some clarity on the accounting side. I mean, here we are. We've been talking about convergence between the IFRS and US GAAP for about 15 years. Still not there. Still can't agree on, well, something like impaired assets. How fast should impaired assets be run down? Well, I do think there needs to be maximum pressure to move towards one accounting system, which hopefully the United States will enjoy. Another condition is that, and I'm coming to the end, another condition is that we should be encouraging innovation. Innovation in exchange and capital markets as much as we can. We've talked about the derivatives moving on to exchange. We need more thinking, much more innovative thinking about how to help small and medium-sized companies, how to make the bond markets more transparent. How do we deal, this is a big subject in the G20 and the Financial Stability Board, you'll see this referred to in a couple of weeks. How do we deal with the long-term financing instruments for infrastructure, PPPs, legacy assets, and all of that? I think there's a lot of potential here for development. We've got to avoid, haven't we, oligopolies. We've got to avoid silos choking off choice, and we've got to avoid, at all costs, protectionism. And I think, I often say this, but I think one of the unsung heroes of this financial crisis has been the WTO dispute settlement system, which has constrained governments from taking protectionist measures. Because if they did, there would have been heavy costs involved and penalties. So let me end with, on an optimistic note, and I think can't quite provide that optimism of Robert, but I think we should be thinking very optimistically about the future, the conditions for that to happen. And pressing, you should be pressing the world's regulators to build those blocks for what I think is an inevitable, very large increase in market-based financing with fantastic opportunities for the exchange world. Thank you very much.